Have you ever been told that life insurance can double as an investment for you? Well, depending on who's talking to you about it, it can be positioned as the greatest thing since sliced bread or one of the biggest ripoffs that's out there in the financial services space. The truth typically lies somewhere in between. As you've seen from a lot of my previous videos, everything is situational when it comes down to working with clients and helping them find the right product to solve what they're trying to achieve. In today's video, I'm going to specifically go over variable universal life insurance, aka VUL, because this is the one that has really the most market upside potential, as well as the biggest risk if you're looking to use permanent life insurance for investment purposes. We'll break down how it works, the pros and the cons of it. And if you stick around to the end, I'll share with you some of my insight from being a financial advisor for the last 16 years, working with clients to help them build and protect their wealth, as to some of the, behind the scenes or sort of intricacies that you should be aware of when someone is talking to you about looking at one of these particular products. My goal here with the channel is to be completely independent, give you my viewpoint on things. Doesn't mean I'm right, doesn't mean I'm wrong, but also to share with you a lot of the common insights that I've seen, how people position these products over the years, so you can be aware of it when you're going out and potentially looking to put something like this in place. So at its core, VUL is a type of permanent life insurance. Chart up. You've seen me do this in a little bit of a different format in the past, but just think of it like this. There's two main types of life insurance products or policies that are out there. You have term insurance, and then you have permanent insurance. Now with term, you're not going to really have too many product sets that are associated with it. It's really going to be defined by the duration of the policy that you put in place. But with permanent insurance, there's four main types, or if you want to really hear something cringe, I've seen insurance salespeople in the past talk about four different species of permanent life insurance. So you have whole life, variable universal life, aka VUL, index universal life, IUL, or universal life, UL. They all work a little bit differently, but at the end of the day, they provide you with permanent death benefit that's going to last you your entire life, versus term insurance, which is just going to give you a death benefit, no cash value. It's going to be the least expensive, and it's going to protect you for that defined period of time, and that's it. So as we've talked about in other videos, the real play, or the way and the reason that permanent life, whether it's whole or VUL, has so much controversy is typically because of how it's sold, which is, I think, a derivative of the cash value. And so when you start talking about how there's cash value and you can access it and it grows tax-free and you can borrow against it, that's then where this whole permanent life insurance or life insurance conversation turns into more of an investment conversation. But at the end of the day, those four species of permanent life insurance policies are all going to do the same thing. They give you that permanent death benefit. So that way, if as long as you don't lapse the policy, there'll be a permanent death benefit for your beneficiaries at some point in time. But the difference with VUL versus the other species is the fact that the cash value can be invested in what's called sub-accounts. You can think of it like this. As you know, when you pay your premium every single year into a permanent policy, a small percentage will go to the cost of the insurance, so that way you have the death benefit in place, but the greater percentage will go into the investment of that particular policy. In this case, with a VUL, it's the sub-account. But what dictates the growth of that cash value and your death benefit is the result of how your investments perform. So that's the difference versus, say, whole life, which is going to be a crediting interest rate that the insurance carrier credits back to you as the policyholder, which is based on how that particular company did from an investment perspective and how it's sort of aligned and the guarantees that they're going to give and things like that. So think of it like this. With a VUL, you have unlimited upside, but you also have unlimited downside, versus whole life, which is going to have very consistent growth with a guarantee built in. IUL is going to have a cap at the top and a floor, so you can get a little bit of both. Now let's break down the pros and the cons of VUL. And then again, I'll share with you some just buyer beware things that you should know if someone's talking to you about these particular products or policies or strategies. The first pro of a VUL is the obvious. It's the growth potential. It's the fact that you can really grow this policy with max upside depending on how the market is doing, but more importantly, how your money is invested in those sub accounts and how those sub accounts perform. But you can also have unlimited downside as well. So that's why you'll see in the life insurance 101 for VUL, you'll see that both the death benefit and the cash value can go up and down, because that's in fact what can happen depending on what's happening with the market. The tax advantages, that's usually what really triggers a good amount of the interest, I think, in these particular policies. It's the fact that you can put in after tax dollars into these particular policies. The money is going to grow tax deferred and ultimately come out tax free, assuming that you funded it correctly. And it's hard to do that in a lot of other places. Also, you presumably have more flexibility in terms of, what you can contribute in a year in, year out basis than say whole life. Now, the whole life people will kind of say the contrary, but I would talk to whoever you're dealing with to really dive into this a little bit more to see what the ramifications are if, you decide to skip a year or two, or maybe not fund the policy to the max of where it's sort of illustrated to be. Also, what a lot of people tend to like, I feel that with a VUL, is the transparency. What you see is what you get. With a whole life product, everything is bundled in. So that typically drives people crazy. When they look at it and they say, okay, I'm putting $10,000 into this policy and it's buying me $500,000 of death benefit, and I see my cash value grow, and I see some other columns here in the ledger and things like that. But I can't quantify how much this is actually costing. If you look inside of a VUL towards the back of the illustration, there'll actually be ledgers that are going to go over exactly what the charges are. So you'll be able to see what the cost of insurance is and what the expenses are, things like that. So people are able to, especially the analytical types, are able to go in and really figure out what the actual cost is going to be for having this particular policy in place. Whereas opposed to whole life, it's really a mystery. And a lot of times that drives people crazy. And then the other thing is that over the last decade, VULs have actually become more consumer friendly. For a while, there was a little bit of it just felt like there was like a little bit of a negative connotation for that particular product set. It could have just been how I was maybe influenced. I don't really know, but I will say that I did used to see a lot of aggressively illustrated sort of policies. And also the carriers kind of put some restrictions on what you could actually illustrate, as well as giving you the ability also to add in guarantees. They call it like a no lapse guarantee. So I think one of the real benefits and things that people liked about the whole life is the fact that it's guaranteed to grow as long as you're funding the policy when you're supposed to be funding it. But VULs came in with something called a no lapse guarantee. So it said, as long as you fund the premium every single year, no matter what happens with the market, your policy will never lapse. And that's important because of the fact that the cash and the death benefit can go up and down in a given year. And I'll get into that a little bit more in a minute. But the VUL companies that really specialize in this particular policy and product have done a much better job, I feel, as far as how they've structured these policies over the recent years. Now, the cons. So the cons are pretty obvious. It's really market risk driven. Because your cash value is invested in these sub accounts, you have unlimited upside, but you also have unlimited downside. And this plays into my other con, the fact that with a VUL, there's complexity involved in it. And so what I mean by complexity is it's not a set it and forget it. You have to manage it. You have to look at it occasionally, not every 5 years, but maybe every year at a minimum, just to make sure that, your investment in those sub accounts and how it's allocated aligns with what you're trying to achieve and aligns with making sure that the policy stays in good standing and that the values, whether it's the cash and the death benefit, don't dip below and underperform, because you could be in a situation where in 20, 25, 30 years down the road, if the policy didn't perform as well as it should have, because it doesn't have any guarantees or any caps and floors in place like with an IUL, that maybe you might owe more money to keep the policy in place because of the underperformance. So it isn't a set it and forget it. Also, what drives some of the ways that sometimes these policies have underperformed and you have a situation where you owe more premiums in the future or something like that, is because of the cost of the actual insurance. Because with the VUL, because you can see all of the costs associated with everything, as you get older, the insurance costs get more expensive. So if your policy is underperforming, it's eating away into the values of the policy even more than it had been before. So that's just something to keep in mind. And lastly, let's just talk about the buyer beware and the things to just be on the lookout for when someone's talking to you about this particular policy. So again, make sure that those illustrations are not too aggressively illustrated. Again, there are restrictions on what you can, how rosy of a projection you can give. But I've also seen most situations happen where a prospect or a client will look at it and they'll want to see that, what happens if the market never returns anything for the rest of the life of the policy and what happens to it. But I would say have a conservative growth rate attached to the illustration so you get an idea of where it conservatively speaking, it should be. I mean, obviously, the market's returned, roughly 10% over the last 20 or 30 years, but you want to just be conservative because you just never know what can happen. Also, I've seen some people compare a VUL to being better than a Roth, and that's not necessarily all the case. They're very different. I get the idea of where someone's coming from that, just because the fact that in a VUL, you can, depending on how much you can afford to fund in it, it can be unlimited versus being capped within a Roth, but a Roth doesn't have any sort of, the possibility of having a lapse or any, disruption to the insurance that's associated with it. So they're different. Also, agents will typically say, hey, if you fund this and the market does well, the policy is going to fund itself. And so you can use that cash value to fund it. Maybe after 15 years of positive growth, you might not need to fund it anymore. So you just need to be careful about that too. And just understand that could be a little bit over of an oversell a statement that an agent or salesperson could be giving you. And then lastly, and this is I want to be very careful about how I say all of this, but you want to be very mindful of when if you're in a conversation talking about any type of permanent life insurance, be careful about who is actually pitching it to you. So what I found is that over the years, when you're meeting with someone and you're discussing life insurance options, they don't even really know what's available out there. They kind of loosely know. They maybe have heard of term and they maybe have heard of whole, but they don't really know how all of this works together, or that there's an investment component built into it, and that those investment components can work differently depending on the product. So what I'm suggesting and saying is that you want to look at the disclosures of the person that you're talking to. That can either be in their business card, maybe in their email, maybe on any of the materials that they leave behind. You can even ask them if you want, because what happens a lot of times is you might be sitting in front of a Northwestern Mutual agent who's going to really be pushing whole life mostly, but maybe he's Joe Smith at ABC Wealth Advisors. And so when they're having a conversation and then they come back and the first thing they talk about is whole life insurance, you would know why. Same thing on the other side. You could be talking to somebody who's a part of Equitable or Prudential, but they're with ABC Wealth Advisors. And so when they come back, they're talking to you specifically about VUL. Yes, both people can get you a VUL if you're Northwestern, and Prudential can get you whole life if you wanted. But most likely they're going to come straight out of the chute with what they represent and what they're really incentivized to sell. It's not that they're going to make any less by selling either of the other products or policies, but they don't get credit towards their what's called career agent status or record, and it doesn't go into their retirement package and things like that. Plus, it's easier for them to do as well from an underwriting perspective. And I'm not saying this is a bad thing. And I'm saying this because I come from the Mass Mutual career agent system. I left that because of the fact I wanted to be independent. I wanted to look at everything from a very unbiased perspective and not have any influence by the powers that be to dictate what it is that I was suggesting to clients that I was working with based off of how someone else is incentivized. I'm not saying these people are bad. I'm not saying this is a bad approach. I'm just saying it's something to be aware of. So make sure you look out for those disclosures and just understand who is pitching it to you and that they have the right intentions to get you what you're looking for. I think this is something that many people don't talk about, and I definitely haven't heard it within the YouTube realm. My last 2 points, what carriers are typically the strongest for VUL? I mean, those are going to be the stock companies. So the Prudentials, maybe Pacific Life, maybe a Principal or John Hancock or somebody like that, Corebridge Financial. Those are stock companies. They tend to have the better VUL products for whatever reason. Mutual carriers, and the same thing can be said for IULs, but mutual carriers like Mass Mutual, Northwestern, Guardian, New York Life, those are their flagship product, as I've talked about in my last video, are going to be really more whole life centric and very strong from that perspective. Now, who whole life is right? Now, who is variable? Now, who is VUL right for? As we've talked about, and as I always talk about, it's situational, but it tends to be for higher income earners, the people that have done well. They've sort of maxed out the ability to fund, they're maxing out their 401k. They can't necessarily contribute to an IRA because they make too much money and they have extra dollars that they're saving and they're looking for ways to invest it. Those tend to be the people that this specific policy and product is right for. But again, it really just depends on what you're trying to solve for and where you are in life. And also make sure that you're not being sort of suggested a premium and a contribution that is outside of your means because of the way that these career agents masking themselves as other advisors come into you and suggest a premium or a contribution to one of these policies. Because at the end of the day, I kind of like VUL from a permanent life insurance perspective. I like whole life too. IUL can be a little bit controversial, but again, it really just depends on the situation and what you're trying to achieve. So with all that being said, I hope you found this video helpful. If you did, please give a thumbs up because that really helps our community grow as well as our ability to see what people like. Because unfortunately, because of compliance purposes, and this is a very regulated industry, you can't leave comments, but feel free to give me a call. Book a time to speak with me, send me an email on anything you like, you think I could do better, whatever it might be. And also subscribe so that way you can stay in contact and in touch of any future videos that we release. And with all that being said, we'll see you in the next one.
If you're ready to take your financial planning to the next level with a customized approach, feel free to reach out to us. This way we can help determine if we can even help you or even point you in the right direction. The best way to reach out to us is through our website at sandersmith.com. Thanks for watching. For more valuable tips on financial planning, check out those videos here. And if you found this information helpful, please like and subscribe so you don't miss any future content.